So you're investing in US stocks from India? That's awesome. But let's be real. The tax rules can feel like a total minefield. Well, today we're giving you the map. Let's jump right in and figure this out.
So, I've got to ask you directly. Does this sound like you? Maybe you've bought some shares on a US platform, or perhaps your company gave you stock options, ESOPs or RSUs. If any of that rings a bell, you're really going to want to pay close attention.
Because look, if you don't stay on top of this stuff, things can get messy and fast. And we really don't want you getting caught off guard by one of those official-looking envelopes. So let's break down exactly what you need to do, starting with your first big obligation.
Okay, first things first. Your number one responsibility kicks in the moment you sell your shares. This is all about capital gains tax. And honestly, there's a huge misconception we need to clear up right off the bat.
Here's the absolute crucial point, so listen up. It does not matter if you've brought the money back to India or if it's still sitting in your US brokerage account. The second you sell those shares, boom, that's a taxable event. You have to pay capital gains tax in that financial year. Full stop. Waiting to bring the money home does not delay your tax bill.
Now, for all of you out there with employee stock options, ESOPs, things get a little trickier. It's often called a double whammy for a very good reason. You're actually getting taxed at two completely different moments.
And here they are. First, when the shares are officially allotted to you, that's called vesting, that value is taxed as a perquisite, basically like it's part of your salary. Your company usually takes care of that with a TDS deduction. Then, maybe years later, when you actually sell those shares, you'll pay a completely separate capital gains tax on whatever profit you made. Two events, two different taxes.
All right, let's move on to your second big obligation. See, it's not just about selling. If you're holding on to those US stocks, chances are you might get paid some dividends. And yep, you guessed it, that income is taxable too. And this is probably the question popping into your head right now. You see the dividend hit your account, but you also see that some tax was already taken out in the US. So you're thinking, wait, do I have to pay tax on it again here in India? Well, thankfully, the answer is no.
And the reason is this fantastic thing called a DTAA, or Double Taxation Avoidance Agreement. Think of it as a pact between India and other countries like the US that says, hey, we're not going to tax the same money twice. It's a lifesaver, but you have to actively claim that credit.
So how do you do it? Well, it's a pretty straightforward three-step process. First, you need to get a document called Form 1042-S from your US broker. That's your proof. Next, you need to fill out Form 67 here in India. And you have to do this before you file your regular income tax return. Do that, and you'll get the relief you're entitled to. Okay, on to our third and final obligation. And I'm telling you, this is the one that trips so many people up, because it applies even if you haven't sold a single thing all year.
That's right. The simple act of just owning foreign assets means you have to report them. It doesn't matter if you made any money from them. It doesn't matter if you didn't sell anything. If you hold them, you must declare them on your Indian tax return.
And it's not just a little checkbox either. You have to get pretty detailed in a special section of your tax return called Schedule FA. You'll need to report things like the current value, the highest value it hit during the year, where the asset is, purchase details, the whole shebang. Now, here's an interesting little side effect of all this. The moment you own foreign assets, you can no longer use that simple one-page ITR 1 form. You'll have to upgrade to ITR 2 if you're salaried or ITR 3 if you've got business income. Okay, I can almost hear what some of you are thinking right now. Oh no, I've had these stocks for years and I had no idea I was supposed to report them. It's a really common situation, and yeah, it can feel a little scary. But take a deep breath, because there is a way to fix this. The government actually has a voluntary disclosure scheme. It basically gives you a window of opportunity to come clean about any past undeclared assets and get right with the taxman without facing those really harsh penalties. Whew. Okay, that was a lot of information, I know. So let's pull it all together and boil it down to a simple action plan. Think of this next slide as your go-to cheat sheet. This table really makes it crystal clear. If you got a dividend, your job is to claim the tax credit using Forms 1042-S and 67. If you're just holding assets, your action is simple. Disclose them in Schedule FA with ITR 2 or 3. And if you forgot to disclose in the past, your path forward is that government voluntary disclosure scheme. Easy, right? So when you boil it all down, owning foreign assets comes with 3 key duties: paying tax when you sell, paying tax on dividends, and disclosing what you own. Getting this stuff right is all about investing with peace of mind. So we'd love to know in the comments, do you hold international stocks or have you gotten ESOPs from your company? Let's talk about it.